The stock market is doing exactly what it's designed to do. It's transferring wealth from the impatient to the prepared. While everyone is panic selling their winners to protect their losses, the smartest money on Wall Street is shopping. This isn't a crash, it's a clearance sale on some of the biggest monopolies in history. Today we're breaking down 5 stocks that are currently on a deep discount, including one that just hit a 52-week low that is a literal monopoly. Microsoft just reported a monstrous Q2 of 2026. Revenue is up 17%, and for the first time ever, Microsoft Cloud Azure just hit $50 billion in revenue. They're growing like a startup at a multi-trillion-dollar scale. Despite beating, Microsoft is trading nearly 30% down from its 52-week high. Wall Street got spooked by $37.5 billion of capex, mostly focusing on AI chips and data centers. Additionally, there was some concern about Microsoft's backlog. Microsoft's remaining performance obligations, or RPO, basically their guaranteed future revenue, hit a record $625 billion, which sounds great, right? But for the first time, CFO Amy Hood revealed that 45% of the backlog is from OpenAI, and investors are terrified this might be one giant circular money machine. Microsoft gives OpenAI billions in cash, and then OpenAI hands it back to receive Azure credit. If OpenAI stumbles or loses some venture capital funding, nearly half of Microsoft's guaranteed growth could vanish, and that exact fear is giving you a 30% discount. Despite this, Microsoft has a tremendous asset. Their product is incredibly sticky. 83% of businesses use Microsoft to run their machine. Small, medium, and large banks are using Excel daily, along with Teams, Outlook, Azure, PowerPoint, and Word. These companies, even if Microsoft increased the price tremendously, would still pay as all their information is already in Microsoft Suite. None of the major businesses are going to change from Excel to Google Sheets just because Microsoft increased prices. Additionally, every operating system is being run on Windows. Big corporations are not going to change from Windows to Linux or Mac OS. They're going to stick with Windows, the product their employees know best. The buy thesis? Microsoft is an incredibly sticky business. Once an enterprise is locked into Azure or Office 365, the cost of switching is a corporate nightmare. Additionally, the company would need to teach every employee to learn a new operating system, new softwares, and new operations if they change from Microsoft's ecosystem. You aren't just buying a software stock with Microsoft, you're buying a global utility used by almost every major company on the planet. Most investors see ServiceNow as a simple IT help desk tool, but in reality, they are the platform of platforms. They sit on top of messy legacy systems like is the guaranteed money coming in over the next 12 months. It's growing at 21 to 25%, which is incredible for a company of this size. Their specific AI product, Now Assist, just hit a $600 million annual contract value, ACV, on its track to cross $1 billion by the end of 2026. This isn't just AI hype, this is AI revenue. Similar to Microsoft, this company is extremely sticky, boasting a staggering 98% renewal rate. Additionally, they are growing with large customers. They are moving rapidly upmarket, and the number of customers paying over $20 million a year is growing at 30%. Once a company builds its HR, IT, and security workflows with ServiceNow, the brain of the company is inside their software. Removing it would be detrimental to the company. Meta just announced a staggering $115 billion to $135 billion in AI spending just for 2026. While Microsoft spending scared the market, Meta spending is actually driving revenue already. Ad conversions are up 24% due to AI. While it held up better than most, it is still seeing a 15% pull down from its 52-week high. Meta is constantly working on Llama 4 and Project Avocado. Meta is additionally able to keep people on its products despite constantly adding more ads. Each time you go on Instagram or Facebook, you're littered with ads, but you keep scrolling. That's how good the ads are. Of course, there's always the risk that Meta's spending on AI doesn't play out, but so far it's been working. As a company with nearly half the planet, 3.5 billion users on their platform daily, Meta has access to more people than nearly anyone else. Netflix has achieved escape velocity. While their competitors, Disney and Paramount, are struggling to break even, Netflix is printing billions in free cash flow. Down 40 Down 40% from its 52-week high, the market is still digesting the Warner Brothers and HBO deal, and investors are worried about the debt load, or that the deal might not even go through. However, I think this deal is very likely to go through, as Warner Brothers is currently struggling and Netflix is there to save the day. Warner Brothers and HBO have one of the best film libraries in history. Names like Harry Potter, Lord of the Rings, DC Universe, Game of Thrones, Adult Swim, I can go on. This is the key thing that Netflix is missing. Netflix hit it big with Stranger Things and Squid Games, along with big hits like K-pop Demon Hunters. But overall, Netflix is missing that crown gem of golden assets. Netflix thinks it's worth to spend the money and buy all those assets so that they can keep more subscribers on their platform. Additionally, Netflix has the potential to expand in the future. They can go into gaming or music, just as they are currently delving into the podcast space. Ad revenue is exploding. It's expected to double again this year. AI can help Netflix by dubbing thousands of movies into many different languages for anyone across the planet, expanding reach instantly. Of course, there's always the bear case that AI will become good enough to start making episodes of its own, providing content to users for free. However, film writing is incredibly hard, and I doubt we are anywhere close to an AI being able to write a perfect script or create a perfect show. S&P Global is what we call a quality compounder. They aren't just a rating agency, they are a diversified financial powerhouse. Nearly 2/3 of their revenue is recurring. They recently raised their 2026 guidance, expecting 7 to 8% organic growth and a staggering 50% adjusted operating margin. It's currently sitting about 22% off its highs. The market is worried about two things: high interest rates slowing down corporate borrowing, and the complexity of their recent business reshuffle. Here's the big news. S&P Global is currently in the process of spinning off its mobility division, which includes Carfax, into a new company called Mobility Global. While this is a good revenue segment, it only has margins in the range of 30%. By cutting it loose, the new S&P Global becomes a leaner, higher margin beast. Their other businesses pull in margins of upwards of 70%. The management is literally trimming the fat to make the business even more profitable with higher average margins than before. Most people think of S&P and immediately think of the S&P 500, but S&P Global is much more than that. They have 4 distinct money printers: ratings, fees for grading corporate debt and government debt; market intelligence, tools like Capital IQ, used by every major bank; commodity insights that set the global benchmark for oil and gas prices; and indices. They get a tiny slice of everything named S&P. The AI bull factor here is that they own decades of proprietary financial and commodity data. Training AI on clean private data is the holy grail for Wall Street, and S&P owns the library. As interest rates fall, more companies are going to be eager to get their loans refinanced. S&P Global is a legal oligopoly, as trillions of corporate debt are set to expire between 2026 and 2028. Companies have to go to S&P Global to get rated so they can refinance. Essentially, you are buying a toll bridge that every corporation on Earth has to eventually cross. Overall, the market is red. Headlines are scary, but the fundamentals of these 5 companies have never been stronger. My safest bet here is Microsoft. Even with the OpenAI risk, they're one of the only companies that can afford to make a $200 billion mistake and still be one of the most valuable companies on Earth. Don't let a 5-day chart scare you out of a 5-year fortune. So I'm buying this dip. Are you?